Picture this. You wake up one morning, check your bank account, and everything looks fine. Your money is sitting there just like always, but somewhere in Washington, a flag has already been raised on your account. Not because you did anything wrong, not because you're a criminal, but simply because of the amount of money sitting in your checking account right now. And here's the thing that nobody is talking about. The IRS is rolling out new banking rules that are going to affect millions of ordinary Americans starting in 2026. And if you don't know what these rules say, you could find yourself dealing with audits, frozen accounts, penalties, or worse, losing money you worked your entire life to save. Most people have absolutely no idea this is coming, and that is exactly why you need to watch this video all the way through. Before we go any further, if you are someone who wants to stay ahead of government changes that affect your money, your bank account, and your financial future, hit that subscribe button right now. This channel exists for people like you, people who work hard, who save carefully, and who refuse to be caught off guard. Don't let a change you never heard about cost you everything you've worked for. Now, I want to be very clear about something before we dive in. This information is time sensitive. The rules going into effect in 2026 are already being put into place behind the scenes. Banks are already updating their internal systems. Government agencies are already preparing. And most Americans are going to wake up one day and wonder what happened without ever having seen this coming. If you have a spouse, a parent, an adult child, or a close friend who keeps money in a checking account, and that's most of us, please share this video with them. Because what we're going to cover today could genuinely change the financial decisions they make in the next few months. This isn't dramatic, this is real. Welcome to this channel. We are dedicated to one thing and one thing only: making sure that everyday Americans like you are informed, prepared, and protected. We dig through government documents, banking regulations, IRS announcements, and policy changes so you don't have to. We translate all that complicated language into plain English, because you deserve to understand what's happening with your own money. If this is your first time here, welcome. And if you've been with us for a while, you already know that the information we share here is not the stuff you'll hear on the evening news. It's the stuff that actually matters. Hit subscribe and turn on the notification bell so you never miss a critical update. Now let's get straight into it, because the clock is already ticking. Let's start at the beginning. What exactly is changing with IRS banking rules in 2026, and why should you care if you have a checking account? Here's the situation. For years, there has been a growing push inside the federal government to give the IRS more visibility into your personal bank accounts. Not just what you report on your tax return, not just your wages or your investment income. We're talking about the actual movement of money going in and out of your checking and savings accounts on a regular basis. Now, you might be thinking, wait, isn't that already happening to some degree? And you would be partially right. Banks have long been required to report certain things to the IRS and to federal regulators. But what is changing in 2026 goes much further than what most people realize. And the threshold, meaning the dollar amount that triggers reporting, is something that directly affects middle-class Americans. Regular people, people who are not wealthy, people who are not hiding anything. This is where it gets serious. So let's walk through this carefully. First, let's talk about something called bank reporting thresholds. Right now, banks are required to report cash transactions that exceed $10,000 in a single transaction. Most of you probably know about that rule. It's been around since the 1970s. It was originally designed to catch drug dealers and money launderers. And for decades, it stayed at that $10,000 level. But here's what a lot of people don't know. There's a practice called structuring, where people would deliberately break up deposits into amounts just below $10,000 to avoid triggering those reports. The government caught on to this, and they expanded the rules to allow banks to report suspicious patterns, even if no single transaction hits that $10,000 mark. So if you were making deposits of $9,000, $8,000, or even $5,000 repeatedly, that could already trigger what's called a suspicious activity report, or SAR. And once that report is filed, the IRS and other federal agencies can take a closer look at your financial life. Now in 2026, this system is being updated and expanded in ways that will reach much deeper into the bank accounts of everyday Americans. And the number you need to understand is not $10,000. It's actually much lower. Let's talk about the new proposed threshold that has been making its way through regulatory discussions, the $600 rule. Now, some of you may have heard about this being debated in Congress a couple of years ago. There was a massive public backlash when it was first proposed, and it seemed like it got shelved. But here's what most people missed. It didn't go away. It just got repackaged and restructured. The core idea is this. The IRS wants banks to report the total inflows and outflows of accounts that have more than $600 in annual activity. And when you think about that number, $600 a year, that is virtually every single American with a bank account. If you deposit your paycheck, if you pay your bills from your checking account, if you receive Social Security, if you transfer money to help a family member, all of that activity would potentially be visible to the IRS in a way it never was before. Now, supporters of this rule say it's about catching tax cheats. They say wealthy people hide income by running it through personal accounts, and this gives the IRS the tools to catch that. And maybe there's some truth to that. But here's the problem that affects you directly. When you cast that wide of a net that catches every single American with $600 of banking activity, you are also catching millions of honest, hardworking people who have done absolutely nothing wrong. And once your account is flagged, once you are on that list, the burden of proving your innocence falls on you. Think about how unfair that is. You worked for your money, you paid your taxes, but now you have to explain to a government agency why money moved in and out of your own checking account. That is an incredibly stressful, time-consuming, and expensive process, especially if you end up needing a tax attorney or an accountant to help you navigate it. Now let's talk about the specific amount you should never leave sitting in your checking account, and why. Financial experts and tax professionals have been quietly advising their clients on this for months, and the consensus is this. The more money you leave sitting in a standard checking account, especially in large round numbers, the more attention it can draw. And in a world where IRS scrutiny of bank accounts is about to increase dramatically, attention is the last thing you want. Here's the general guidance that is circulating in financial circles right now. You should not leave more than a few months of essential living expenses in your checking account at any given time. For most Americans, that means keeping checking account balances somewhere between $1,000 and $3,000 for day-to-day use. Anything beyond that, and we're talking about significant amounts sitting idle, not moving, just parked in a checking account, can raise questions. Why? Because checking accounts are not designed for long-term savings. When large amounts of money sit in a checking account and don't move, it can look unusual to automated monitoring systems. It can look like money that came from somewhere undisclosed. It can trigger a review. And here's the real kicker. You might think that because the money is just sitting there, not being deposited, not being withdrawn, it's safe from scrutiny. But that's actually backwards. Inactivity combined with high balances can be just as suspicious in the eyes of these automated systems as unusual activity. Let's talk about who this affects most. Because this isn't a story about billionaires trying to hide offshore accounts. This is about you. This is about people in their 40s, 50s, 60s, and 70s who have been responsible their entire lives. People who saved their money carefully. People who maybe sold a home and parked the proceeds in their checking account while they figured out what to do next. People who received an inheritance. People who got a settlement from an insurance claim. People who sold a car or a piece of property and temporarily put the money somewhere they could easily access it. All of those situations, completely legitimate, completely legal, can now trigger IRS scrutiny under the expanding rules going into 2026. Here's a real-life scenario that illustrates how this works. Let's say your mother passed away and left you and your siblings an inheritance. After splitting it with your siblings, your share comes out to about $40,000. You deposit it into your checking account because you're not sure yet whether you want to invest it, pay off debt, or help your kids with a down payment on a house. That deposit gets flagged. The bank files a report. The IRS takes notice. Now, you're receiving letters asking you to explain where this money came from, even though it's completely legitimate, even though taxes may have already been paid on it before it was passed down to you. You are now in the middle of a review process that could take months and cost you thousands of dollars in professional fees to resolve. This is not a hypothetical. This is happening to real people right now. And in 2026, it is going to happen to far more people as the rules tighten. Let's talk about something called the Bank Secrecy Act and how its evolution ties directly into what we're discussing today. The Bank Secrecy Act has been around since 1970. It was created to fight financial crimes. Over the decades, it has been amended and expanded multiple times. And every time it gets expanded, it gives the IRS and federal law enforcement more access to your financial information. What's happening leading into 2026 is the latest and arguably the most significant expansion of this framework. And it's being driven by two things. First, the the federal government wants to close the so-called tax gap, which is the difference between what Americans owe in taxes and what they actually pay. The IRS estimates this gap is somewhere around $600 billion a year. That's a lot of uncollected tax revenue. Second, with the growth of digital payments, cryptocurrency, and peer-to-peer money transfers through apps like Venmo, Zelle, Cash App, and PayPal, the IRS has realized that vast amounts of financial activity are happening outside of traditional reporting channels. So they are pushing to expand those channels dramatically. And here's the part that should concern you personally. When the IRS is trying to close a $600 billion gap, they are not going to limit their scrutiny to obvious high-income cheats. They are going to cast the widest possible net. And that net is coming for regular checking accounts across America. Now let's talk about something that surprises a lot of people. The IRS doesn't just look at what you report. They also look at what they call lifestyle indicators. This includes things like the money flowing through your bank accounts compared to what you report on your tax return. So here's where it gets really important. If you have significant amounts of money moving through your checking account, even if it's completely legitimate, and it doesn't match what your tax return shows as income, that discrepancy can trigger an audit. Let's say you made $60,000 last year according to your tax return. But between all of your deposits, transfers, and transactions, $200,000 moved through your checking account. Maybe you were moving money between accounts. Maybe you received insurance payouts. Maybe you lent money to someone and they paid you back. Maybe you sold some personal property. All of that activity is now potentially visible to the IRS under the new reporting rules. And if it doesn't match your reported income, even if there's a perfectly innocent explanation, you could be asked to explain every single transaction. Can you explain every transaction in your checking account from the past 2 years right now? Most people can't, and that is exactly the problem. Here is something else you need to know. And this one genuinely surprises people when they hear it. There are already rules on the books about large cash withdrawals that many Americans don't know about. And these rules are being reinforced and strengthened heading into 2026. If you walk into your bank and withdraw more than $10,000 in cash, your bank is required to file a currency transaction report, or CTR, with the federal government. No exceptions. No way around it. This happens automatically, and you may not even be told that it happened. But here's where it gets even more complicated. If your bank employee believes you are making withdrawals in a pattern specifically designed to stay under the $10,000 threshold, they can file a suspicious activity report even if none of your individual transactions ever hit that limit. So if you regularly withdraw $8,000 or $7,000 or even $5,000, especially on a somewhat predictable schedule, you could already be generating SAR filings without knowing it. And starting in 2026, the systems designed to catch these patterns are getting more sophisticated. The data sharing between banks and the IRS is getting more seamless. Artificial intelligence is being used to flag unusual patterns more quickly. What used to take months to review can now be flagged almost instantly. Let's pause for a moment because I want you to really absorb what we've been talking about. The rules around your checking account are changing dramatically. The threshold for triggering IRS attention is coming down. The sophistication of the monitoring systems is going up, and the consequences of being flagged, even if you've done nothing wrong, are serious, stressful, and expensive. This is not about being paranoid. This is about being prepared. And the best way to protect yourself is to understand these rules and adjust your financial habits before the changes take full effect. So let's talk about exactly what you should do, because this video isn't just about scaring you. It's about giving you real, practical tools to protect yourself. Here is your practical action plan. These are the steps that financial experts and tax professionals are recommending right now, ahead of the 2026 changes. Step 1. Don't use your checking account as a savings account. This is the single most important thing you can take away from this video. Your checking account should be a transaction account. Money comes in, money goes out. Pay your bills, cover your expenses, keep a small buffer. That's it. The balance in your checking account should reflect your monthly cash flow needs, not your life savings. A good rule of thumb is to keep no more than 2 to 3 months of living expenses in your checking account at any given time. If you have $10,000, $20,000, $50,000 or more sitting in a checking account right now, you need to move some of that money. Not because you did anything wrong, but because that much money sitting in a checking account is not serving you well financially, and it is increasingly drawing the wrong kind of attention. Step 2. Move excess funds into appropriate accounts. There are accounts specifically designed to hold larger amounts of money safely and legally without drawing unnecessary scrutiny. High yield savings accounts, money market accounts, certificates of deposit, and investment accounts all serve this purpose. These accounts are also reported to the IRS, but they have established, recognized purposes. Large balances in these accounts are expected and normal. Large balances sitting in a checking account are not. Step 3. Keep records of large deposits. Anytime you receive a large sum of money, an inheritance, an insurance payout, the proceeds from selling a car or property, or a gift, write it down. Keep the paperwork. Have documentation that clearly shows where the money came from, because if the IRS comes asking, you want to be able to answer clearly and quickly without scrambling to find records from 2 or 3 years ago. Step 4. Be careful with cash transactions. If you regularly deal in cash, whether you're self-employed, run a small business, or simply prefer cash, be extra careful about how you deposit and withdraw. Stay consistent. Don't make large, irregular cash transactions. And if your business is cash heavy, talk to a tax professional about the best way to structure those transactions legally and cleanly. Step 5. Talk to a tax professional before 2026. I know that not everyone loves spending money on a CPA or a tax attorney, but here's the truth. A 1-hour consultation with a qualified tax professional could save you from a multi-year audit nightmare. They can review your banking habits, help you restructure how you manage your money, and make sure you are not accidentally doing things that will draw scrutiny under the new rules. Step 6. Be aware of Zelle, Venmo, Cash App, and PayPal. If you are using any of these apps to receive money, especially for any kind of goods or services, you need to know that the reporting thresholds for these platforms have already changed. Starting in 2024, these platforms are required to send a 1099-K to anyone who receives more than $600 through their platform in a year. That's right, $600. If you sold something online, did some freelance work, or even regularly receive money from family members through these apps, the IRS may already be getting a report about that. Make sure you understand what is and isn't taxable and keep good records. Step 7. Review your bank statements regularly. This sounds simple, but most people don't do it carefully. Go through your statements and make sure you understand every transaction. If someone asked you tomorrow to explain where every deposit came from and what every withdrawal was for, could you do it? If not, start getting organized now. A clean, explainable financial record is your best defense against any kind of IRS inquiry. Now let's talk about something that affects a specific group of people especially hard: retirees and those living on fixed incomes. If you are retired, if you're receiving Social Security, if you have pension income, or if you are drawing from retirement accounts like an IRA or 401k, you need to pay close attention to this section. Here's the concern. Retirees often have money sitting in multiple accounts. They might have Social Security going into one account, a pension going into another, IRA withdrawals being deposited somewhere else. And sometimes they consolidate all of that into one checking account for simplicity. But here's the problem with that. When multiple streams of income flow into a single checking account and large balances build up, it can look unusual to automated monitoring systems, even if every penny of that income is completely legitimate and properly reported. Additionally, many retirees receive money from their adult children, help with living expenses, gifts, contributions to household costs. These transfers, especially through peer-to-peer apps, can create taxable reporting situations that people don't expect. And there's another issue that hits this group particularly hard. Cognitive decline, or simply the stress of managing finances alone after losing a spouse, can lead to mistakes in how money is managed. Large amounts sitting in checking accounts because it feels safer. Irregular withdrawal patterns because of confusion or fear. These are exactly the kinds of patterns that can trigger attention, and that's deeply unfair to people who are already in a vulnerable situation. If you have elderly parents or relatives, please watch this video with them. Help them understand how to structure their accounts in a way that keeps them protected. And if you need to, help them get the professional advice they need. Let's talk about something that rarely gets mentioned in these conversations: your rights. Even if your account is flagged, even if the IRS opens an inquiry, you have rights. You have the right to an explanation of what is being questioned. You have the right to respond with documentation. You have the right to professional representation, meaning a tax attorney or CPA can speak to the IRS on your behalf so that you don't have to face this alone. You also have the right to appeal IRS decisions if you disagree with their conclusions. And in cases where the IRS has made errors or acted improperly, there is even a taxpayer advocate service, a free government resource that helps taxpayers navigate situations where they feel they are being treated unfairly. Knowing your rights doesn't mean you're doing something wrong, it means you're prepared. And preparation is the difference between a minor inconvenience and a financial catastrophe. Now, let's zoom out for a moment and talk about the bigger picture, because some of you might be feeling frustrated right now, maybe even angry. And honestly, that's a reasonable response. Here's the truth. The vast majority of people who will be affected by these expanded banking rules are not tax cheats. They are not criminals. They are working people, retired people, small business owners, and families who are simply trying to manage their money. And yet the rules are being applied broadly, not surgically, in a way that puts the burden of proof on the individual rather than the government. There is a real conversation happening in this country about whether these expanded IRS banking authorities are appropriate, whether they represent government overreach, whether they disproportionately burden middle-class and working-class Americans, while sophisticated wealthy tax avoiders find ways around them. But here's the reality. Regardless of what you think about the policy, these rules are being put in place. And while the debate continues in Washington, you need to protect yourself now. You can't wait for Congress to figure it out. Your financial safety in 2026 depends on what you do today. Let me bring this home with one more thing, because I want to make sure you leave this video not just informed, but truly protected. The amount you should never leave in your checking account is this: more than you can immediately explain and justify, more than you need for your monthly expenses and a reasonable emergency buffer, more than represents your normal, regular financial activity. For most Americans, that means keeping checking account balances in the range of $1,000 to $3,000 for everyday use, maybe up to $5,000 or $6,000 if your monthly expenses are higher, but not $20,000, not $50,000, not the proceeds from a home sale, not an inheritance, not long-term savings. Those amounts belong in accounts that are designed for them: savings accounts, investment accounts, retirement accounts. Accounts where large balances are expected, normal, and recognized by the banking system and the IRS as legitimate. Moving your money into the right accounts isn't hiding it. It's managing it correctly. It's what every financial advisor will tell you to do. And in a world where IRS scrutiny of checking accounts is about to reach levels we've never seen before, it is also how you protect yourself from being caught in a dragnet that was never designed for people like you. We'll see you in the next one.